Hi, warriors, traders. You know, it's really a compelling and interesting interview when I have either Chris Carolyn at Spiral Calendar or Peter Campbell from at MCM underscore CT underscore USA, the longest Twitter handle. Oh, I mean X handle on the network. So having them both here together is dynamic. They both come from different methodologies. At times, their work agrees. In fact, welcome, Chris, Peter. Welcome back.
Thank you.
Uh,
Thank
yeah,
you.
I had you guys on late summer, early fall, and you both had a bearish bias in the market, and they were good forecasts up until a week ago. So we had that 12% decline in the market, basis S&Ps about, and then a bolt of lightning hit last week. Chris, why don't we start with you? Because, the way we went home into the war, lower close, etc., um, I thought we could have a bounce, maybe retest 4,200. That was a breakdown. But the impulsiveness of the move was very surprising to me, and I'm sure surprising to others. What changed besides the obvious of people thinking the Fed was done? The Treasury offerings were, better packaged, and then the weaker than expected NFP and a potential peak in yields in a bond rally. Was that it? Just the fundamental news, or,
Well,
or
I think
go
the
ahead.
other piece was Japan, and on Monday they kind of leaked out that they were going to allow rates to go up, but then that's what they were saying. But at the same time, they went into their market and bought bonds, and there was a massive liquidity injection. And I look at the market day to day as two components: liquidity and sentiment. And I snapped this chart like moments ago, um, because I believe even despite this rally, the only way the rally can continue is if the dollar sells off. And
Okay.
as soon as we see any dollar buying come into the market, you see the VIX pop, which is what that chart shows right there. But
Okay.
if, for liquidity,
Yeah, so we had that double top in the dollar around 107.20. We pulled back. My view is the dollar correction isn't over yet, that, we could trade 104.50 or so, but I still think there's another wave up in the dollar
yep,
after
and
this
and
correction.
and that's I think part of the bear argument for equities. But okay, the top clip here, this is just the net percent difference in change between the yen and the dollar. And this was last Monday, or no, that was Tuesday, actually. Yeah, that's Tuesday. And this is just this massive, the yen collapsed without a
Yeah,
corresponding move in the DXY. And that, this the moving average of this indicator, it tracks the S&P nicely. You can see this liquidity is getting removed, the
yeah.
S&P, and then we just took off. And this was a massive uh this weekend did so much, I think, last week. And then at the end of the week, we had a weak dollar, and so that helped. So the it's
So
all about liquidity and sentiment.
all right. So everyone thinks liquidity only comes from the Fed, but you're saying it was the injection of liquidity from the BOJ that kind of turned things Monday, because people went into the report believing the BOJ that they were
Right.
going
Well,
to do.
because when they first leaked that, the yen strengthened
Right,
briefly.
right.
But then once they actually started acting in the market, here it is. I mean, it was just massive. And we can see subsequent um, to that what went on. Let's
And then by the end of the week, Chris, the yen had strengthened again.
Yeah, they've
making it
sort of play
almost.
they
Go
right.
ahead.
But if it's strengthening at the same time the DXY is weakening by a
Right.
greater extent, then that's not a negative.
And
It's
the dollar did weaken.
yep.
Okay. All right.
So now this is the seasonality chart, which is the average of other years with um, similar
Yeah.
lunar cycles, but it ignores eclipses. Uh, and so the seasonality it kicked in later, but you can see this past week, this is a very strong period. Now we're entering this time where, yes, in November, it's all historically very strong, and we'll see if it can maintain it. I'm skeptical.
Okay. All
Now
right.
this is tides, and I've said for a long time these October lows all come in on what are called spring tides. Um, the legend here, these negative numbers are the size of the change in tide. So the biggest tide changes are at the bottom of the graph, and they line up with the October lows. This is 2020. You can see in 2021, the market bottomed on the extreme tide.
Yeah.
2022, and then this was the tide here. This past eclipse, and we went down hard into it. We came up hard out of it.
Can I ask you something for further knowledge? Because,
Sure.
I'm kind of an amateur when it comes to trading eclipses. I've noticed the important turning points occur on them. And I did post that I thought the market could rally into the solar mid-month. But I was, I was aware of the lunar 2 weeks later, but I didn't place as much significance on it. Is that does that pattern repeat when you have, and you usually do have both a solar and a lunar eclipse
You always
within a month,
They're
always?
always you always have two. Sometimes you have
Okay.
three. And
Wow. Okay. So is that a normal setup like what just happened?
well, but it's different every time because there's also the cycle of perigee and apogee, which is
Yeah.
which one of those eclipses the moon will be closer to the Earth, one farther away, and that affects the tide. So that uh, the new moon eclipse, that's smaller tides because the moon was further
Right.
away, and then
The full
so
moon is
this
where
was
you
very
have the,
strong because you
right.
also had perigee where the moon is close to the Earth, and you had the eclipse, and you had these very large tides.
Okay.
Now,
So, okay, here we are.
let me. This is what tripped me up. I We've done a lot of very emotional turns at important points in the last few months, and one of them was that September reversal on triple witching. And we were tracking the 87 very,
I
very
know
closely. I mean,
a lot of people were showing it. Yeah.
the percentages were almost, were very similar. But obviously, this blew up along
Yeah.
with
Yeah.
other bear
Fair
dreams last week.
arguments. Okay.
I still think because there's been a lot of discrete emotional events, there's still some potential for a little nasty drop at the end of this week. And so
Not enough to challenge
I
the
doubt it.
4100 low?
I doubt that. But
Okay, that's what I mean. So, going forward, do you have to embrace this market now, Chris?
I
I
no,
mean,
I don't think so. And it'd be interested to hear. I know Peter will have some strong arguments. Because this
yeah,
still in many ways looks like just kind of a sea wave move that people mistake for an impulsive beginning of a new uh, major advance. I mean, this VIX chart, this drop just looks very similar to the one that came off of the August bottom, and it
okay.
seems like these different important
This was
points
this
are
was a
producing.
record. This was a record percentage drop. So it may look like that, but in magnitude, it was larger.
Yep, yep,
I mean, the biggest 1 week move in the VIX to the downside historically.
yep.
So, okay, so what my takeaway is the real key thing to watch for now is when and if the dollar turns back up.
Exactly. Yeah.
All right, let me ask you this, and then I'm going to move on to Peter. Can the dollar move up and still have lower yields and a bond market rally continue?
Uh, Only if the Japanese play. That's
Okay. All
they're
right.
they're the third wheel.
Okay. So really everyone's got to focus on the BOJ. To you, it's more important than what the dollar is doing, isn't it?
Or it's as important because
As.
it can neutralize or it can magnify the effects either way.
Okay. All right. Thanks, Chris. Peter, I know that you haven't pulled in your horns like Chris
No,
has.
I have a lot of good charts for you today,
All right.
and I think they're going to paint a pretty interesting picture, to say the
okay.
least.
All right. So, I'm kind of with Chris, although I'm taking a shot today for a trade. I shorted some NASDAQ 100 with a 100-point stop. We'll see what happens. I mean, the momentum was so strong, it took all this time just for me to get divergences on a 15-minute time frame. I mean, the 4 hours, you have readings over 80, a lot. I mean, so much mo that it's hard for me to think it's going to turn into something big. But on a micro time frame, what do we have? 9 days up in a row, Peter?
Yeah, something like that, 8 or 9.
All right. So, Chris, if you stop sharing, Peter could bring up his bear porn.
Okay.
All right. Ladies and gentlemen, please take your kids out of the room. It's not advisable that they hear about, it would, it scares adults. So we don't want to scare any children. Go ahead, take it away, Peter. I'm girding myself for your presentation.
Okay.
All right.
So let's start. Wait a second. Why is this not?
There, you got your orthodox parabolic top up there.
Yeah, but wait a second. I gotta share an album. 1 second. I'll share the screen.
Yeah.
There we go. Okay, so you guys should see my screen.
Got it.
And then we start with this chart.
Okay.
So can you see it?
Yeah, we got it.
Okay, so this chart is a really important chart, especially when people are losing their mind, as they are now. One of the reasons that for most of
20 Peter.
Yeah.
I took a hit last week.
Yeah. One of the reasons that I was looking for 3,500, 3,600, 3,650, kind of 37 on the S&P to hold, and then see a test of 4,400 in 2022 was because of this expanded flat, the orthodox parabolic top, etc. And the other reason was because we didn't have an inverted yield curve, which suggested that that was the right setup. So we weren't going to materialize the recession everybody was thinking of at that moment, the way they were thinking of it. So now, if we look where we are here, we have an inverted yield curve, and that's occurring right here. And interestingly, this is a beautiful parabola that breaks down at 4280, which I think we can be at very quickly and break it back down. And once we do this again, it will not come back.
So what do you say, Peter, to, I know you're an Elliottician. You're a practitioner.
Not really.
All right. Well,
really.
I mean, your base case is it's an expanding flat.
Yeah, but
and that's why people have been getting it wrong. That's an Elliott thing, right?
I wouldn't say not really. The expanded flats and running corrections are regular technical patterns that got nicely adopted by Elliott wave. And what I've found is that those are the ones where when you get them wrong, you get destroyed, which is, what happened off of the October situation last year. And then, also at the same time, it's happening again. I'm going to show you what I mean, but let's look at the emotions of where we are. In the emotional cycle, we're still around the everything is okay theme here.
Yes.
This is just the S&P 500, the real prices repeating its pattern. And you can see right around here, we had the same kind of bounce, although not as big as we're getting actually right now. You see that little uptick where we are? Well, that looks very suspiciously like the 2008 thing before the wheels fell off. So I am not changing anything about what I am seeing, and this chart helps to put it in perspective. This is basically the actions that I've taken this year. I have covered short-term contracts, along the way, but my long-term positions I still have, and I'm planning on keeping them. What is interesting about this is that we are doing a retest and struggling up here. And I think when we get rejected from that, we're dealing with the catch down to this larger expanded flat shown in the red dots. Now, people who haven't seen this chart before, I don't care about 1987 per se. What I care about is the way that the flat played out in 1987. And basically one day in 1987, because we have so many computers now, is something like 6.2 days now. So everybody thinks computers make things faster. They make things slower, actually. So people are less decisive. They have more information. Everything that you think is going to happen happens at a much slower pace. So we are looking, at, to me, maybe we're going to right translate a little bit and be a little later, but I still think that this scenario is likely to happen because of the expanded flat. So the expanded flat completed. We are now retesting the breakdown. I didn't expect it to come up this high to retest. I figured we'd had so many expanded flats. I figured we wouldn't see another expanded flat. I thought we'd see, a running flat or something different just to mix it up. But expanded flats are horrendous because they're the kinds of things that a central bank would do to bankrupt people on both sides of the market. Expanded flats are deleveraging processes that basically blow up both sides of the market.
Okay, well, I'm glad to have added liquidity to the formation. Let me ask you this, though, Peter. Is there any level, it's kind of like a fundamentalist, they're bullish something and it gets cheaper. So the fundamentals are still good and, they go, wow.
Well, when the structure breaks, I would say that the scenario is not likely to happen, but I haven't had that happen. And that's part of the problem here. If you look at this chart, this is what's happening in the market now. Now, I'm not concerned with the Elliott wave labeling on this. I don't really care about Elliott waves, and I'm not particularly good at it. But when you have an expanded flat or a running flat, it's characterized by an irregular low. So a low that is made without 5 waves in it, and that traps all the people. So you end up in a very unhealthy low, and you end up usually exceeding or meeting the high of the, like, for example, A, where I have A labeled here. So we got an expanded flat, and I took for granted personally, which was a mistake, that I thought that we would just have, a bounce to a running flat, which would have been maybe to 42.50, something like that, 42.70, and then reverse from there. Instead, we're noodling around here and not giving it up. But the problem with the expanded flats is that they convince people to be more bullish, as you can recall when we were at 46.40, than they are in any bull market. And I would say when you look at the people in the market right now, they're literally frothing at the mouth bullish. It's more bullish than I remember at any time during pretty much.
They feel that Paul gave them the all clear. So you and I talk.
But the problem with what we have right now is we have a huge expanded flat that started in 2022, or really 2020, end of 2021, that has now gotten to the point where we are.
Okay.
And now we have another expanded flat. So we're in the breakdown of the previous flat, and we're in the breakdown of this flat. So when this flat turns and we go back down, we're probably dealing with a crash, like a really serious crash, much more serious than what I was looking at before. Because
could one of the reasons be, Peter, and it's something that you and I talked about, and I brought it up to Chris, that if this bond market has turned, you said that it could create some liquidity issues as people don't want to miss these rates and they want to lock them in. And that would mean at least a reallocation of stocks to bonds, which would mean selling stocks and buying bonds on.
Yes, that is definitely what I believe is going to happen. Okay. Now, just to I'm going to touch on that subject in the next chart, but I want to show you this because this, again, I posted this before, but this is, forget the where we are here thing, because where we are is the red box at the top. So you can see that this defines pretty much everything that's going on. Every bear has given up. Nobody believes anything except that the market's just going to keep going up, and it's a beautiful situation that's going to rally the market to 6,000. Yeah. Seasonality, everything. But we're following this. People should maybe do a screenshot of this and then, look at the phases of these structures psychologically. The other thing that's a big problem with this is we had a huge move. And you see a lot of people coming up with really bad excuses for breadth thrusts. But we don't have a breadth thrust. What you see on this chart, the green dot is a bullish breadth thrust. We don't have one on this spike. And what we had on the left is bearish, capitulation. So the yellow dots are the opposite of thrusts, they're capitulations. But if this was going to do what everybody thinks, we would have a breadth thrust that was similar to the one that happened. And also, while you remember nobody was bullish over there, I was really bullish.
I remember
back there,
3,800. Yeah,
3,800. And then at 4,100, when people thought we were going to fall apart, I was pointing out this breadth thrust and that it could resolve significantly higher, and then the average return from that breadth thrust should be about 8%, and I think we went to 10 or something like that.
Okay.
Or 11, I think we hit. Anyway, the problem is Manx.
Yeah.
So, I think we have a lot of like psyops going on in the banking world where they're coming out and telling you your checks aren't clearing or your deposits aren't coming. And
what do you think
they're getting people ready for some banking event. It sounds like to me. I don't take this seriously in the sense that it's actually technical failures going on. I believe we are dealing with an agenda by the central banks that they want to implement so that they can say, well, if you want to prevent these problems, you have to go to central bank digital currency.
Right. I've been talking about that. Yeah.
Yeah. And
it's by design.
Yeah. And similarly in Australia, the biggest internet network plus cell network is down, and you can't really do much banking. A lot of banks are saying they can't transact because they don't have internet, blah, blah, blah. This is really not good stuff. Now, this chart is going to be an interesting update today. Now, I'm going to zoom into this. This is the S&P 500 measured in its real costs. So it's real cost versus the yields in bonds versus the prices of risk versus other markets versus other countries versus everything that I can find. And basically, when you get to the top of this channel, you're most likely going to get turned away. I did not expect us to come and test this again. I'm betting today we probably will hit the top of that channel again since we're so close. But what does this do? Right now, we are the most expensive in the history of data that I have for the S&P 500. And we're going into a recession, whether people like it or not. So what I see here is that when we turn down from this, we have then a triple test of this resistance. We are dealing with a very big problem, and it's going to
Yep,
shock
that'd
people
be a
because
third
they're not.
drive, a
Yeah, they're
third
not.
drive.
Yeah,
Yeah.
yeah, they're not ready for it. And then this is my volatility projection, which goes out 3 years. So volatility is on a steady rise to go much, much, much higher, like all-time highs, higher than in 1987. And these projections, have worked very well. And it was another reason that I was bullish in 2022 at the end of the year, especially when we got down into those lower numbers in the 37 to 3,500. I was really thinking we would get a big move from there. Also because of these things. So, I think that any sort of brainwashing the market's doing here to get people to think that it's going to go up is propaganda. This is a chart I think I shared with you a while ago. It's the time series chart. So this market is in a series right now to go down into February next year, then bounce, and then go down again into the fall. If we follow this normal cycle, which I don't see why we wouldn't, because believe it or not, this particular cycle of 40 weeks has been working for a long time, and it will work in many different, it just depends on how big you think that decline or whatever is going to be, but the cycle itself has been very good. So this is talking about the bond situation that you were bringing up. Basically, capital has to flow from stocks into bonds, in my opinion, and that's what this chart is showing. And it's showing the equal weighted S&P, a NASDAQ, and the NASDAQ. And so basically, the NASDAQ itself needs to drop like 44 to 46%, in my opinion. If bonds are rallying, like right now, it would have to drop like 52%, 55% to get to
on a mean reversion you're talking about?
Yeah, on a mean reversion, but that's that's not likely, because bonds are, if they're going to continue to rally, are going to come up closer to the S&P. I don't think bonds are going to have like the rocket ship rally that much, but I think that they can rally another like 5% pretty easily, 6-7%, and then during that time, the NASDAQ itself needs to lower its positioning from versus bonds, in the sense that capital, if it's not coming from QE going into all markets, we are going to have a rotation, in my opinion, from high risk into lower risk and more sustainable returns. And so if we're looking at the equal weighted index, the average stock, we're looking at like something like 35% lower, 40% lower to probably meet where bonds will be. If bonds have a super sharp rally, then the declines would be less in the markets, in the equity markets, in my opinion. But I think that we do have to have a rotation from risk into bonds. And what's telling the truth here? Well, what's telling the truth to me is the Russell 2000, which is a great barometer of everything from credit to whatever. Even though, we have like now essentially 3 companies that are holding up the entire rest of the stock market, other people are having credit problems, and they're having business problems. And
don't bank on the banks.
Yeah, and the Russell is now putting in a third lower high here, which it rejected pretty soundly. And I don't think we're going to, maybe we can go a little lower and then it could extend itself up and retest that trend line. But I don't think that, I think the Russell's done. That's my opinion. This is the equal weighted S&P. To me, this looks done also. So I would say that what we would be looking at, if the S&P non-equal weight wants to continue to noodle around, it may do so while the equal weight doesn't make new confirming highs. This is S&P 500 where this channel is, and I think that we're dealing with a false breakout somewhere in here. And this fits.
What would make it a false breakout? Trading or closing back under what?
Closing basically back under 43.60, 43.50.
Okay,
and
that
then
was a big number. Okay,
you're really below 42.80 would be like huge. That would be unrecoverable, I would think, for the market.
okay.
This is my geometrics analysis, which has Lucas timing on it. We hit Lucas timing yesterday. And this looks about right, that, we should be somehow putting in a turn after this many Lucas timings that sort of paused the market. Now we should see a turn, maybe get a drop into the end of the week that is setting up for a right shoulder, and then see a much bigger decline in the markets.
All right, let me ask both of you guys now, Peter, that this time of year, just this time of year, liquidity begins to dry up, right? Markets become thinner. And is that the condition that would make the market more susceptible to bear rates? Chris, what do you think?
Well, we had a down December in 2018. So yeah, we can generate some downside at this time of year. I just think it's watching closely the VIX and the title dates and seeing where the emotion is and fading.
VIX pulled back 78.6 from its low of 12.50 to the high of 23. I think 1480 is 78.6 back. Peter, why don't you show your vol chart, because it's a mind blower of what you think is going to happen, because people have been making a fortune selling vol, and they just had a huge week last week if they were selling vol. They're the ones with their pockets are full right now. When does the steamroller come?
That's the thing, is I think it can come at any point here because it's so extended and people are so complacent. And I think this chart is an interesting one because it does put in perspective something else, which is the relationship between copper telling the truth versus the market telling a lie. And at the bottom, what you can see is when we get into this red area, we tend to get tops. And we are in a huge non-confirmation from copper versus the S&P 500, as you can see. And it ticked down. So now
Dr. Copper was sued for malpractice for impersonating a bull market.
Yeah.
Yeah, are you following that court case, Chris? Anyway, all right, go ahead, Peter.
And then here we have another thing, which I'll go back to the vol chart after this. My personal opinion is that we have this banking problem. And if you look at what happened in the banking crisis in 2007, we had the situation where we had a bull flag on gold, and we had a breakdown on the regional and banking indexes as a whole.
XLF.
And XL, and then here we have a bull flag and a breakdown, which this has gotten much further along than that. This is a little bit of an old chart. And this puts in perspective the bigger picture, I think, on gold, which is, if that's the case, then gold likes to do, a measured move that is 3 of those boxes. So this 5K? Looks like, no, that's probably more like 15 or 20. Wow. Because this is looking like, gold set up kind of for a 2030 agenda, which is what the UN's goal is, to restructure the world. And so this looks about right to me.
All right, Chris, do do you share Peter's, outlook about, this agenda and resets and, these are all trades, but I think we should dedicate a few minutes, Peter, I mean, with the charts of what should viewers do in this environment? Go to cash, go to gold, um, uh, debank. I know, Peter, you're not a fan of crypto. Chris, I mean, what are you doing if we see this writing on the wall?
Uh, well, don't live in a big city anymore, and
That's smart.
yeah, and so I'm on the edge of a university town. I kind of think that's a decent place, and
Okay.
it's defense. Where I think the agenda stuff you have to look at it in perspective that um, there's all these people who are extremely wealthy on paper, and the tide of history is going to wipe that out. And so, all their actions are trying to preserve that fiction. And, so when you look at central bank digital currencies or any of these other things, the end goal of all of it is to preserve these elites with what they have so they don't lose it. But, history comes in those destructive ways. What was it, 406 AD, the Rhine River froze and the hordes crossed the river, and 6 years
Changed.
later, Rome was sacked. So,
Yeah.
I
Yeah.
mean, we see the hordes on both,
Yeah. Europe and Asia and Middle East.
everywhere. The hordes are moving. We're
Yeah.
seeing that, and history tells you what follows.
Okay. Well, Peter, I'd like you to build me a time machine.
Yeah.
I want to go backwards. So you guys could come. All right. And Peter, what are you doing? I know you're a trader, a position trader. You could make a fortune on the downside in an event like this, but with the world we're heading into, what's the point? That's what I
Well,
ask
I
myself. So what's the
well,
point?
I think that you have to rotate into physical property over time. I think it's okay for a year or two or three, but who knows? But
Yeah.
before 2030, I think people need to you need to have your property in a place where you can get it, and that would mean physical
Yeah.
gold, physical silver, and like if you think that crypto will work, well, I more power to you. I don't think that the people in Australia right now with no telecommunications are really thinking that crypto is solving their fundamental problem right now.
That's a great point. It's a great point. And why don't you guys tell me a little bit? Because I've had friends that I used to talk to every day in the markets, and what a benefit it is to have a relationship like you two guys have. I didn't know that you guys were friends, and I'm sure it came from a common interest in the markets. Does it really help to have each other and be sounding boards, or you just, I know that's a major topic of
It's
conversation with
mostly
you.
it's mostly about drinking.
All right, well, okay,
We
that's
get together
that's
and have a drink,
that's
No,
fine.
no,
All
no, no.
right,
I have tremendous respect for Chris's work, and I've always believed that the markets and people are controlled by natural phenomena more than they are the actual dynamics that they think are driving things.
yeah,
And Chris is one of the only people who, you know, um, looks at that in a way that is, really refreshing. I thought that his analysis into these events right now was tremendous. Uh, what is interesting, however, is that a lot of times when you have very emotional situations in the markets, what you get is a flip. So, so things flip for a period of time, and then the original theory
yeah,
works.
yin yang.
Um, so I kind of look at what's happening right now as I think Chris is going to end up the whole emotional setup that he's looking for on a broader scale is going to happen. I just think that
Okay.
the short term got a little break here.
Okay, Chris, what do you like about having a connection with Peter?
Um, well, I mean, he's just got so much going on,
It's amazing.
uh, but well, his Tick Tools package, yeah, I have that open on my screen. Actually, I have it on two screens, one upstairs and one downstairs, so I can see it wherever it is or hear it. Um, he's built. I mean, he just as a mind. I just
His
people
mind.
whose minds work in certain ways.
Yeah. Yeah.
Um, fascinate me, and we've just sort of connected. And Peter's background, a lot of people don't know. He was studying piano at Juilliard before he went
Yeah.
into markets, and
Yeah.
and I went to art school, so there's a commonality there. On the flip side, I think the difficulty with Peter is he's got so much coming at you. There are people I think who want to say, let's just say, take money out of the market every day. And,
Yeah.
those sometimes the best thing is just to have one thing and do it well. And, Peter
Right.
can be a distraction um, to that discipline in a sense, because he's just, he's got the polymath thing going on. But I thrive
Yeah.
on it. And
Yeah.
so, yeah, we're sharing thoughts and texts frequently.
So I think it's a great model for traders that are going to be watching this, guys, that they, not isolate themselves and develop some relationships with people whose work they respect and be able to pick up the phone or send a chart to somebody and have that be part of their intelligence gathering. Um,
Definitely.
yeah,
Oh
so I
yeah.
mean, I did it with Jim Welsh for years, and I think it's a big advantage. And thanks for including me in being able to talk to you both at the same time. And
Yeah, this is fun to do this.
yeah,
Maybe we can do it again in the future.
we
I want
will.
to make one comment about what Chris was saying, which is that Tick Tools is very different than the analysis that I'm doing here that I presented to you guys. Tick Tools is a short-term market emotion system. So the whole idea is to find locations in the market that you can act on emotionally, and then more importantly, and this is a theme that comes up for me, is that when you're expecting when you get people panicking, for example, and then markets bounce from that panic, when that panic is then broken down, that tells you what's really going on in the emotions in the market. So if that, so Tick Tools has a lot of emotional kind of events that, if you're short-term trading, are very good, but they're also good for long-term, larger pictures as well. Because when you get a bunch of buyer X ticks and you break them out, then that's telling you that people are going to be they're run over, and that those prices need to be dropped.
Okay.
If everybody capitulates into a buyer event all at the same time, and then we go higher and hold that, it's very bullish. So these are things that Tick Tools does. What I'm looking at here is larger themes, and that was here's our volatility thing, and then the other chart I had before this was the 220 years of the markets, and we're following that stuff pretty accurately. A double top for you know for large head and shoulders on the S&P, from what it looks like to me.
Yeah.
Uh,
A
you
friend
know,
of
uh,
mine, a friend of mine follows the epoch cycle. You guys
mhm.
familiar with that? The epoch, EPOCH? I think it's 100-year cycle. I'm not sure. But I want people to be able to know how to get a hold of you guys. Peter is the best on Twitter at MCM.
Yeah,
Okay, at MCM underscore CT underscore USA. If you're
yeah.
interested in the Tick Tools, and Chris, for your newsletter and all that you offer for people that have want to learn about things like the tides and the movement.
Spiralcalendar.com.
Yeah, go to
And I
Spiral. Go ahead.
and I post on X Twitter.
You do. Oh, you do.
Yeah, and
So, yeah, Peter?
yeah, and I want to recommend something if you can find it. You should look for Chris Carroll's book, The Spiral
Oh, yeah.
Calendar. That's a great book, and it's
Yeah.
good to have on your shelf.
Yeah. Won the Dow Award. So,
Yeah, the book is hard to find. We might get a electronic version out someday.
okay. Well, it's always great seeing you guys and talking to you guys and hearing what your thoughts. I want to thank you for sharing your hard work, Peter. One thing I can say about Peter is he is the best traders and analysts are very hardworking people, and
Yeah.
Peter is obsessed. And Chris, I think you bring some calmness to the equation in your relationship. Really was a pleasure speaking to both of you, my trading warrior brothers. Great interview.
Yeah, and
Thanks,
also
Bill.
just one other thing. My website is mcm-ct.com. And so it's two ways to get mcm_ct_USA is Twitter or X, and then mcm-ct.com is the website.
Good hunting, my trading warrior brothers. See you
Okay.
down the road. See you down the
Catch you
road.
later. Okay.
Adios.